Recent economic data make it clear that we're entering a deep and synchronized global recession. What that means for companies which have too much leverage on their balance sheet is an increased probability of default. So what we're talking about is a global credit crisis. Now, to discuss that and to answer your questions, but also to help you navigate your portfolio through this crisis, I'm holding a live Q&A session on Saturday the 11th of April at 7 p.m. London time. There'll be more details in the link above. So let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. First, let's see what we mean exactly by credit risk. Whenever one entity makes a loan to another, in this case a loan of £100, they're hoping that at some time in the future, which is the maturity date, they're going to be repaid that loan. Meanwhile, while they wait for the debt to be repaid, they may earn some interest. And if it's a bond, that's called the coupon. So here we have 5 years of annual coupon payments, and the coupon is 1% of the loan amount. If the company has a higher credit risk, then you'd expect to be compensated for taking that risk by receiving a higher coupon. And the reason for that is that you might get a default, in this case between years 2 and 3. That means that the company becomes bankrupt and you run the risk of not getting your remaining cash flows. So just as with any investment, the greater the risk you take, the greater the return you expect. And so the yield, or the income which you're going to expect, will be greater for a bond with greater credit risk than one with less credit risk. The reason why companies go bust is down to the structure of their balance sheet. The way accountants work this out is to say that you split it into two sides. On the left-hand side, we've got the assets of the company. That's its property which generates its revenue. So in the case of a company, that might be the factory, or it could be the set of services which it offers its clients. On the liability side, we can see how we funded the company. So how did we pay for those assets? There are two primary forms of liability. That's equity, which is the money that's been given to the company by the shareholders in return for ownership of part of the company and also control of the company. And the other type of liability is debt. And that's when the company issues corporate bonds, but it could also be in the form of loans from a bank. Now, of these two forms of liability, the equity is the one which has to shrink when the size of the assets falls. So in that sense, the equity is the loss-absorbing liability. Your bondholders will still be owed the same amount of money even if the size of your assets shrinks. Now let's look at a situation in which the value of the assets falls. Notice how the size of the equity shrank, but the size of the debt didn't. So I'll just flip back and forth one more time so you can see that more clearly. This is before the assets shrink, and this is after. The level of debt didn't change at all. And notice how the size of the equity has got even smaller, such that if the assets shrink again, the equity might be wiped out completely. And if that happens, the company will go into default and it becomes bankrupt. So one way to gauge the risk of bankruptcy is to look at the relative size of equity and debt on the balance sheet. And the ratio people usually use is the debt to equity ratio. How many dollars of debt do you have for every dollar of equity? So let's look at that for Ford Motor Company. This data is freely available on the website gurufocus.com. So Ford Motor Company has $102 billion in long-term debt, $54 billion in short-term debt, and $33 billion in stockholders' equity. And if we add these and divide by that, we can see that we've got about $5 of debt for every dollar of equity. And that's a pretty high debt to equity ratio. So we should certainly be concerned about Ford Motor Company's credit quality. And if we look at the automotive sector in America, we can see the distribution of the debt to equity ratio. And the red bar is where the Ford Motor Company falls in that distribution. It's one of the most leveraged companies in the sector according to this measure. In contrast, if we look at Google's parent company, which is called Alphabet, their total debt compared to their equity is much smaller. their debt to equity ratio is just 0.08, which means that for every dollar of shareholder equity, they have about 8 cents worth of debt. Now, tech companies tend to have a lower debt to equity ratio because they're less capital intensive. But even given that sector's low debt to equity ratio, Alphabet is still one of the least levered companies in the sector. So its credit risk is extremely low. Now, whenever we talk about credit, we always consider this thing called credit spread. And that's the compensation that investors demand in order to take the credit risk of a company. Now, how do we gauge the credit risk of a company? We could look at many of those measures, like debt to equity, but many people rely on these things called credit ratings. And the three largest providers of those ratings are Moody's, Standard & Poor's, and Fitch. Now, the highest credit quality is considered to be AAA, but when we get down to BBB, we cross a boundary, which takes us from what's called investment grade credit, which is high quality and less likely to default, to speculative credit, or what some people rather unkindly call junk bonds. And these have a credit rating of BB or lower. Now we can split up the yield on a bond, which is roughly the income which you'll receive for holding the bond, into several components. Part of the bond yield is the risk-free rate, and that's the yield you'd receive if you bought a government bond, which has effectively a zero credit risk for developed market countries like the US, the UK, and Japan. Layered on top of that is a spread which compensates you for the possibility of losing your capital due to default. And you also get compensation for taking liquidity risk, which is a risk that you can't sell the bond quickly in the event of a crisis. Illiquid assets simply take a long time to sell, and bonds issued by companies, corporate bonds, certainly fall into that illiquid asset category. The yield on a junk bond will also have the risk-free rate, but its credit spread and its liquidity spread will be larger than they are for investment grade. And that's because junk bonds tend to be less liquid, they take longer to sell, and there's a higher probability of default. And that's why another name for speculative credit is high yield. Now, as market conditions change, those yields move up and down all the time. So here we've got the AAA yield for US corporate bonds, and it varies between about 2% and about 4% from 2015 to the present day, whereas the yield on single B bonds is much larger because of that credit spread and also the liquidity spread being much larger. So at the end of March, the yield on AAA bonds was about 2.1% in the United States, whereas the yield on single B was almost 10%. And because yields move in the opposite direction to prices, this rapid increase in the yield corresponds to a sell-off in the price of US corporate bonds. If we just look at the credit spread and we take our analysis back to 2008, AAA bonds went up to a spread of almost 6%, whereas high yield went up much higher, above 20%. And although the current sell-off is very rapid and very large, yields at the end of March were still far below where they were in the middle of the financial crisis in 2008. So we could see those spreads widen further if credit conditions deteriorate. So why am I particularly concerned about a credit crisis right now? Because we've just had a decade of almost zero interest rates, there's been a reach for yield. So investors have gone for more and more speculative credit in order to increase income. And the proportion of global investment grade, which is now at the lowest credit quality, which is BBB, is about half. Now what we've just witnessed is income falling for many companies across the world. And if that's the case, then a great deal of investment grade debt could get downgraded to high yield. It'll cross that boundary from high quality bonds to junk. Now, the people who own most of that paper are institutional investors. Now, some of those funds are only allowed to buy investment grade bonds. So if some investment grade bonds get downgraded, they become forced sellers. And as we've seen, that means the credit spread on those bonds increases rapidly as their prices fall sharply. When it comes time to replace that debt, companies with weak balance sheets will have to issue at a higher cost of funding. And that means the cost of servicing their new debt will be considerably higher. And if it costs more to service that debt, then their probability of default increases. And so we have this doom loop. We've already seen the first part of that cycle because downgrades are outpacing upgrades at a rate of 3 to 1 since the beginning of the year in 2020, and that's the fastest rate of downgrades since the global financial crisis. But don't think that this is just a US phenomenon. The rate at which companies go bankrupt, called the default rate, tends to be correlated across regions. So for example, when the dot-com bubble burst, the rate of defaults increased all over the world. And in 2009, we also saw a pickup in default rates all over the world. So this time round, it's also likely to be a global phenomenon. So we've seen what triggers the crisis. The timing of the recovery is absolutely critical. The journalist Tracy Alloway has created a nice summary of the different shapes of recovery. You may hear people talking about a V-shaped recovery. That's the sharp variety because it looks like the letter V. A U-shaped recovery takes longer. L-shape suggests that there's a permanent loss of output, but strategists are always coming up with novel shapes. For example, Nomura has come up with a tick-shaped recovery, which means we get a very sharp fall and a very extended period to recover to where we were before. The reason why timing matters is because companies have to roll over their debt. As some of their bonds mature, they still need to fund themselves, and that means they have to issue new bonds at a higher cost of funding. So over the next 4 years, JP Morgan estimates that about $5 trillion worth of debt will have to be rolled over, and a considerable proportion of that, shown in blue, is speculative grade. Now, if this is something of a short, sharp shock, then hopefully we'll have pulled out of recession and credit spreads will have tightened before too much debt has to be rolled over. But if it takes more than a couple of years, then we could be looking at a very significant problem for companies with high leverage. The FTs produce this really useful China Economic Activity Index, where the bright red line starts off on January the 1st at a value of 100. Now at the end of January, the Chinese have the Lunar New Year, and activity kind of tails off until we reach that festival, and then it picks up very rapidly afterwards. But this year, because Wuhan was shut down, you can see that it hasn't recovered, and it took several months for activity to start to recover. The index is broken down into subcomponents, and some of those have recovered to their usual level. For example, real estate floor space sales have recovered. Coal consumption has also approached previous levels, as is traffic congestion. But it's interesting that air pollution, which fell dramatically during the shutdown, still hasn't risen, which suggests that at least some forms of economic activity aren't recovering as quickly. So for example, box office admissions are still flatlining, and container freight, which depends on exports to other countries which are now seeing a slowdown, are still falling. So that must be very worrying for China. Even if it does get manufacturing going again, its exports will be hit by that lack of demand from elsewhere. Governments across the world are doing as much as they can to soften the economic blow as much as possible. So the US CARES Act has released $2 trillion in order to stimulate the US economy, and $500 billion of that has been earmarked for large and medium businesses. But given the scale of the problem, we still don't know whether that will be enough. Now here we'll focus on US employment, but bear in mind that this pattern is being played out elsewhere. If we look at the US unemployment rate since 1950, you can see that it tends to rise during recessions and then falls again during recoveries. In fact, this is probably one of the most timely indicators of US recession, when unemployment starts to increase. And at the beginning of 2020, it had reached record low levels of well below 4%. In fact, those are levels that we hadn't seen for 60 years. The St. Louis Fed has done a breakdown of US employment based on something called a proximity index, which measures how close a service provider is to their clients. So the one which comes out top are barbers, hairstylists, and cosmetologists. Now, although they don't earn much on average, the fact is that there are many of them. So there are over 1 million people employed in these roles in the United States. The greater the proximity index, the greater the risk that the person will not be able to work during the crisis. And breaking that down into low, medium, and high relative contact intensity, over 1/5 of US employees have a high proximity index, and about 72% of the US workforce falls into the medium or high categories. And if we break it down geographically, you can see that some states are going to be more affected than others. But the thing to bear in mind is that there are secondary effects. If, for example, a hairdresser is laid off, that means they're not going to have any disposable income, except for unemployment benefits, which are fairly meagre in the United States, and any government grants which have been made as part of that CARES Act. That means they may struggle to pay some of their essential bills. If they can't pay rent, it's going to affect their landlord. Skipping utility bills is going to affect those utility companies. If they have to prioritize, the only thing which they must buy is groceries because they have to eat. But any discretionary spending, such as going out for restaurants, movies, or concerts, is likely to be cut completely. And if their income is cut for a very long period of time, they may even struggle to make their vehicle payments, credit card payments, or mortgage payments. So the longer this crisis lasts, the greater the spread of the impact throughout the whole of the economy. And the St. Louis Fed estimates that we could get unemployment of roughly 30% based on these estimates above. Now that's probably a worst case, but the best we can hope for is that that spike is short-lived. If we look at the weekly data, which is called initial claims, that's the number of newly unemployed people who are seeking to receive unemployment benefits. That's just increased above 6 million. And if we look at that in context since records began, it's never been that bad. Not in the oil shock in the 1970s, the Volcker rate hike, the shallow recession we saw in the 1990s, the dot-com bubble, or even the global financial crisis. None of them came close to 6 million initial claims. So that was the case in the US, but the problem of leverage is a global one. The Bank of England identified Chinese households as having a high debt to GDP, and they also said that corporates in the US had a high debt to GDP ratio and singled out the leveraged loan market as being a hotspot, and in China, corporate debt to GDP was also elevated. Now, if we do see a very significant pickup in credit defaults in China, that's particularly worrying for the UK, because the UK banking system has a lot of Chinese exposure. So that's something you should at least be aware of if you invest in UK banks. The Bank of England also highlights France as having a great deal of corporate indebtedness. As a percentage of GDP, France, which is in purple, is at a comparable level to the United States. Leveraged loans are arranged by a group of banks called a syndicate in order for companies with weak credit ratings to get funding, and these companies have cripplingly high debt-to-equity ratios, or debt-to-asset ratios, or debt-to-earnings ratios. Now that market was growing very rapidly until 2019, and that means there's a great deal of this low-quality debt which is owed by what are effectively zombie companies. So they will probably be first in the line of fire when revenues start to fall rapidly, as they are now. Another thing to be aware of is the shadow banking system. What that means are non-bank financial intermediaries. So those are companies or organizations that provide services which are similar to what commercial banks used to do, but at least some of those entities don't fall under normal banking regulations. Now, the Financial Stability Board has estimated the size of the financial assets globally at about 380 trillion, but about half of those assets were created by non-bank financial intermediaries. Now, I'm just going to concentrate on one part of the shadow banking system, which is peer-to-peer lenders. One of the largest in the United States is called Lending Club, and at the end of March, they had to cut their approval rates for high-risk borrowers. And the reason for that is that Lending Club must be assuming that the default rates are about to increase across a huge swath of Main Street. And Lending Club has also increased interest rates from 2% to 4% for borrowers, depending on their loan grade. Peer-to-peer platforms in the UK are in a similar position. Depending on the length and the depth of this recession, the rate of defaults on loans in the peer-to-peer space could pick up significantly. And that's loans to individuals, but also to small businesses. And some peer-to-peer funds have suspended trading, such as Octopus. And that's because lots of investors were trying to withdraw their cash at the same time. So just as we got a run on banks in the UK during the financial crisis, it looks like we could get a run on peer-to-peer platforms. And the shadow banking industry in China is huge. It's over $8 trillion in size. So it was worrying to see calls to nationalize one of the shadow banks after it failed to repay principal on one of its trust products. And investors were worried that the company had become trapped by irreversible systemic risks. So what if, as an investor, you want to avoid leverage? In my video on how to invest during a stock market crash, I created this 2x2 grid which shows highly leveraged and illiquid assets in the top left, which includes peer-to-peer lending, and it has liquid and low leveraged assets in the bottom right. So the very safest things are cash, developed market government bonds, and gold, and perhaps large cap equity, but preferably the ones with the lowest debt. If you want to screen for companies which have good fundamentals, that's called quality factor funds. And if you look at just ETF, you can filter for those companies, and here I've listed some of those exchange traded funds. In the United States, you can do a similar thing with ETF DB. Just look for quality ETFs. Now those quality ETFs track indices created by MSCI and by FTSE Russell, which screen based on fundamental attributes of a company's balance sheet. So for example, this index looks for high return on equity, stable earnings, and low financial leverage. And you can see that its performance has been pretty good compared to MSCI World in yellow. So what's unique about this crisis is the speed at which it started. But what really determines whether we get a credit crisis is the time we take to recover. If that's too long, then the probability of a credit crisis goes up. Remember, you can join our online community for just $10 a month. There'll be a link at the top of this page that will take you to Patreon so you can sign up really easily. And then you can join us on the chat application Slack and ask questions from me and other members of the community, and you get access to our Sunday evening calls, which people find very useful, and you decide the questions for that. Now, as always, thank you for listening.